This lecture will cover insurance basics. We're looking at basically three areas: insurance and risk, the basic policy types, and purchasing considerations. There are some terms that we will cover, but our goals will be to be able to define what risk is and describe how insurance works. The key terms you see are here: risk, insurance, insured, premiums, and insurer. Also insurance policy, coverage, claim, uninsured, and underinsured. When we talk about risk, we are talking about any type of scenario or situation where something bad could possibly happen, usually falling within something financial, physical, or material. Insurance helps to provide compensation for that loss, and it spreads the cost of sharing that risk. How do you deal with risk? Well, there are basically four ways. You can either avoid it, reduce it, ignore it, or transfer it. And when you choose to have insurance, you basically transfer that risk to an insurance company. Take a minute to think of ways to deal with risk. How insurance works? Well, basically you're going to have an insured, and this is going to be the person who buys the insurance. You're going to have premiums, and these are periodic payments for the insurance policy. And then you're going to have, of course, the insurer, and that's the company that provides the insurance. Your insurance policy, well, that's your contract. It's between, if you're the insured person, it's going to be between you and the insurer, the insurance company. And each contract is going to detail the loss that it specifically covers. Coverage, it's going to cover or take care of a specific type of loss. And then your claim is your request for that loss or damage to be covered. Who provides the insurance? Well, probably most of us know that it's an insurance company. And the insurance company could be private, which is a for-profit organization, but it can also be a governmental agency, whether it's the federal government or a joint program between the federal government and the state. Those who do receive government insurance typically pay a minimum or very decreased premiums for their coverage. The cost of insurance continues to increase, and because of that, many will be either uninsured or underinsured, which means they either have no insurance or they don't have enough insurance. And so this is something that has to be considered even when you purchase your insurance policy. Here's a checkpoint. Do you think insurance companies or consumers have more responsibility for the rising cost of insurance? Why? Now we're going to go to the next section, basic policy types. And the goal here is to be able to describe basic property and casualty policies, and then also to describe the basic life, health, and disability policies. Your terms here in this section will be liability, real property, and personal property. We talk about liability, we're talking about who has the legal responsibility to provide compensation for different types of injury or loss. Real property refers to permanent structures and objects like a home and its attached garage. But when we're talking about personal property, we're talking about something that's not permanently attached, and that would be a car or any other type of personal items of value. Automobile insurance, because this is one of the, typically for most of us, one of the most costly or expensive or valuable assets that we have, it's important that we provide protection for it. The most important automobile coverage is going to be liability. There is no fault uninsured and underinsured motorist coverage. With no fault, it's going to provide compensation regardless of who's at fault. If it's uninsured motorist protection, then it's going to provide compensations for accidents that's caused by a driver who is either uninsured or underinsured. And then, of course, underinsured motorist coverage is coverage for items that are not covered by an underinsured driver's policy. Comprehensive coverage. Comprehensive auto coverage covers a multitude of names, a multitude of incidents or losses, hence its name comprehensive. So that will include theft, collision, vandalism, damage from fire. But of particular note, collision insurance should not exceed the value of one's car. Homeowners insurance. This is insurance that's going to cover loss or damage to your home, and that's going to cover the dwelling and other structures that are attached to it, as well as personal property on the insured premises. Additional coverage may include the loss or use of the property, any personal liability, or medical payments in case of an accident on the property. Renter's insurance. This is going to cover the personal possessions of the insured as well as their any type of liability. The owner of that, however, that particular structure is going to be responsible for damage to the for the structure. The renter's insurance is just going to cover those things, those personal possessions or liability. And the coverage is going to depend on the circumstances of the insured. At this point, take a minute to describe the difference between real property and personal property. Life, health, and disability insurance. Because life expectancy continues to rise, and there are variations among races and gender. Typically, Caucasian women will outlive most other categories, and typically African American men have the lowest life expectancy. But the fact that there is an increased lifespan, it's going to increase the need for various types of insurance. Your beneficiary is going to be the person that you name who will receive the benefits upon your death. Now, this is for life insurance. And what you want to consider when you purchase life insurance is the standard of living you want those beneficiaries to be able to receive. It's very important that you don't buy what you don't need. There are various thoughts on what's stated here, but according to a lot of individuals who are well versed in insurance, they feel you don't need to purchase life insurance if you don't have dependents, or if you have assets that you can use to cover expenses and don't have the dependents, then there's really no need for it. Because the money that's not spent on the premiums could be used to be put in investments. So that's just a thought there. Your health and medical insurance plans, they provide compensations for medical costs you incur due to disease or injury. And there are basically two different types of insurance plans: a managed care or fee-for-service plans. And then the government offers plans such as Medicare and Medicaid. Long-term care insurance could be something that is very beneficial if you have some type of long-term illness or disability. There's also social insurance, and this is financed by employers, government, or it could be a combination of employers and government, and it's provided through government-sponsored programs, and which provide monthly benefits. It can provide benefits to the dependents of deceased workers, as well as disability benefits. Workers' compensation and unemployment compensation pays benefits for work-related injuries, as well as occupational diseases that were contracted at the work site, or unfortunately a work-related death. Unemployment insurance, however, provides temporary income to those who are eligible and meet certain criteria and are involuntarily employed or laid off. At this point, describe the importance of government social insurance programs. Our final section is the purchasing considerations, and the goals here are for you to be able to know to discuss and know what insurability and probability is. Be able to explain the product options, price, and company ratings. Here are the terms for this section. And insurability just has, it means that it's an ability for a company or an insurance company to accept you and offer you a policy. Probability, this is a branch of math that measures the likelihood that something will happen. Mortality or actuarial tables are able to determine the likelihood of death rates. Insurance basically screen their potential new policyholders based on personal characteristics or lifestyle choices. And health insurance companies will require evidence of insurability or the ability for you to be accepted to have a policy, and that's going to be based on medical information, whether or not there are pre-existing medical conditions, and you must be honest in your answers. At this point, think about the difference between insurability and evidence of insurability. Before you buy, you definitely want to determine what risk you face, the causes of your risk, identify ways you can handle each risk, and definitely make a plan of action. Product options are going to include special features that you add to a basic policy. These will allow for policy customizations, but they will usually increase the cost of your premium. Pricing, you want to definitely obtain at least 3 quotes before you buy insurance. Compare those policies carefully and thoroughly. One way to increase or decrease the amount of your premium is to have a higher deductible, which is the amount of money that the insured agrees to pay in the event of a loss. And you want to make sure that the insurance company that you're using is in good, stable financial conditions, so you can investigate them using 2 organizations or 2 companies that provide ratings, Standard & Poor's or S&P, and the AM Best. You also want to know what the state laws are regarding the amount of insurance that you should cover. At this point, explain 4 things that you should do before you buy insurance.